Good morning, happy Monday, and welcome back to another edition of Accessible Alpha's Market Update, this time for the week beginning November 25th. As always, trying something a little bit new. What I'm going to try here is I'm going to give you the headline, and then I'm going to give you why it matters, why I'm looking at it, why I think it's important for trading, investing, allocations in general. Hopefully that'll be helpful. Let me know what you think in the comments. We're definitely sticking to this 5-minute format, by the way. It's gone really well. Let me know what you think in the comments. And as always, as I discuss any of this stuff, none of this should be construed as investment advice in any way. It's strictly informational. It's strictly educational. Hopefully it helps. It's a key into my process and how I think of things. So without further ado, this week's episode. All right, first things first, the market up this week, which is nice because last week it was certainly down, but not enough to match or get back to last week's highs. So for last week, the S&P 500 was up 1.7%, NASDAQ was up 1.9%, which is pretty good, and the Dow Jones was actually up 2%. Usually we see obviously the S&P or the NASDAQ outpacing the Dow Jones. Wasn't the case last week, but again, a bit of a sell-off 2 weeks ago, and last week, made up some ground, rallied back, but not back to the highs from last week, unfortunately. The Trump trade, by far, so far, is Bitcoin. So last week, Bitcoin was up quite a bit. It topped at $99,800 US. And as of this writing, which is, Sunday, 1:30 p.m. Mountain Time, right now it's at 96,301. It's up 40% since the election results on November 6th. That's the headline. Well, what the heck does that mean? Basically, what it means is that investors are more risk on. So they're willing to get out of some of the safer asset classes like fixed income. They're willing to get into, the more risky ones. Crypto, I think, is probably the most risky you can get into. But basically, it's a good sign, and it means that investors are willing to go kind of risk things to gain some returns in the markets. We can't think that everything is off to the races though. We still got to have great risk management. And again, like I spoke about last week, just because rallies are taking off doesn't mean you just dive in without doing any sort of analysis. Clearly it's a good thing when things are bullish, but we have to keep our risk management in place. We have to have good setups, and we have to be getting into positions that we feel great about in the onset. And always, when you get into a position, know when you're going to get out of it. Already have a stop in place, even with something, and maybe especially something like Bitcoin. All right, another headline I'm seeing quite a bit is that PE ratios are crazy high, especially with NVIDIA or maybe just stocks or tech stocks in general. A lot of folks are saying, hey, PE is so high. How high can it go? There has to be some digestion. First, and maybe this is a hot take, I don't think PEs really matter. PE is one of those things where, I think about it as the price is the price. It's kind of like housing prices. We say, hey, they can't go up anymore because of some arbitrary rule that we make up, and then the price goes higher. That's how I think about PE. Keep in mind that PEs historically have not consolidated around static or fixed levels. Obviously, they've gone up and down over time, and that's kind of why I think the way that I do about them. We have this very healthy, broad economic climate that's going to impact all equities in a particular market. And if the big ones, if the PE is scary for some folks, and there is some consolidation on the NVIDIAs and Apples and Googles and Amazons and things like that, keep in mind we have thousands of other stocks that are out there, and those are actually trading at a discount relative to their mean PE levels going back a bunch of years. Another big headline that's going around lately, with President-elect Trump talking about tariffs, there's been a lot of talk around what those tariffs would actually do to stock prices. I do think that continues to weigh on the market in a few different ways. For example, we saw NVIDIA come out with their results on Wednesday. Once again, they beat on earnings and revenue, but the price didn't really move. And if you listen to their earnings call, the CEO coming out and saying, well, we don't know how expensive things are going to be in 2025 and potentially and beyond. And I just think that put a damper maybe on the exuberance of NVIDIA stock price. And we've seen that in a few other securities as well. So keep in mind that tariffs work like a tax. It's a one-time increase in price, But after that, margins can equilibrate. So basically what that means is when we think of tariffs, don't think about it as this continual negative pressure on prices. It's basically a one-time increase in price, but then that's it, right? And then the buying behavior of that company's wares, whether it's B2B or B2C, can basically equilibrate over time, and that can dilute some of the negative impact that the tariff can have. Another way to think about this is that if there is a tariff, and it kind of does what it's supposed to do, I'll put that in air quotes, the dollar can actually strengthen. And if the dollar strengthens, that means that the imports can actually be bought more cheaply, and the exports can be sold more expensively in that other currency, which basically helps margins. Lastly, the war with Russia and Ukraine unfortunately continues to persist, and basically this is now adding, more and more uncertainty to kind of global markets. Here's what it means. When we think about kind of global conflicts and that uncertainty that it provides, it means that investors, unlike kind of the Bitcoin story, are not willing to fully get into the equity pool. I use this analogy sometimes where, investors, they kind of want to slowly get into a pool. I mean, think like a water pool, not like a capital pool. They slowly get into the pool, and kind of the joke that I have is that, they're willing to get up to their belly buttons right now, but they're not willing to get their hair wet. And basically what that means when we have this uncertainty is that safer investments like gold, for example, which gold futures were up every day last week, and fixed income, and the yield curve, for example, continues to trade at a discount, which means the yields are still pretty good, pretty attractive. It's providing this strange dynamic because yes, equities are very bullish and things are taking off, but you have some of these safer securities that are still doing relatively well because of some of this uncertainty, and investors are basically having to decide between, both safe asset classes and aggressive asset classes, but they're both doing really well. So, why switch away from, gold and fixed income and things like that? All right, so that was it for this week's episode. Hopefully that was helpful. If you have any feedback, please let me know in the comments. I really want to make this so you can be informed about what's happening in the markets on a week-over-week basis, but also get some information that may just help you think about your trading or investing or allocating maybe a little bit differently. Thank you so much for watching. I'm actually going to be off for the next couple weeks. I'm going to Europe, so I will not be posting out episodes over the next 2 weeks, I believe. So until then, have a wonderful Thanksgiving if you're in the States. I hope you have a great few trading weeks, and I'll see you soon.